Hello and welcome back everyone to another episode of Almus Weekly Windup. This is Swaraj and with me I have our market expert JK, and we will be taking you through the week that has gone by. And this week was quite eventful. We had the much awaited Fed FOMC meeting. We saw some correction in the oil prices. Now oil is dealing below $100 a barrel. We saw some correction in precious metals prices like gold. So, JK, my first question to you is on FOMC. We saw Fed rate hikes by 25 basis, which was in lines with the market expectations. What was the key highlight of that meeting, and how did the financial markets react to it?
Hi, Swaraj. Good to connect again. This was one of the most anticipated Fed meeting in the last few years. Fed was expected to raise rates by 0.25%, and this is the first time they were going to raise after 2018. And there was some debate whether they would hike by 0.5% or 0.25%, but Fed did the measured move of 0.25% hike. Well, the important point is the view on future interest rate increases. And for that, we get a clue from the dot plot, which is which you can see on the screen now. Mm-hmm. According to this, say dot plot is a survey of individual Fed members' expectations on interest rate hikes in the coming months and years. It is not a Fed's plan. Mm-hmm. So what I mean is here, for example, if you look at 2022, say out of 16 members, more than half of them expect the rates to be around 1.9% by the end of 2022. And if you look at 2023, more than half the members out of the 16 members expect the rate to be closer to 3%. Now, this is not a plan by Fed. This is, as on today, the survey taken from individual members, what they expect. It can vary from member to member, and it can vary from one month to another also. In December meeting, for example, the dot plot indicated that there would be only 3 hikes in 2022, and there would be 1 in 2023. And that has completely changed as per the evolution of inflation and inflation expectations. Now, this could again change by the time the future meetings come up. So this is, as on today, what the members expect. This is not a Fed's plan. Fed's action might be different from this. This is the first part of it. Okay. As per this, the most members expect rates to be around 1.9% by the end of this year, 6 rate hikes, and by the end of next year, the rates to be around 2.9%. And again, this is also this 2.9%, just getting away from the dot plot itself. Fed's median rate or the neutral rate, what they call it as, is around 2.4%. So as per this expectation, rates are going to be above the neutral rate. That is based on the current expectation on inflation. To dwell a bit more on what the Fed did, they also said from the next meeting, they would discuss the balance sheet runoff. So which means they would actually start reducing their balance sheet size, which had increased by 6 trillion since the pandemic. Now, I am looking at 2 important things which Powell said in his speech. One, he said the rate rises would check the demand and then bring down the prices. Now, when he says that, it actually means that the consumption is going to be reduced. If the demand actually comes down, its consumption will be less and growth will be lower. So that is one thing that you can conclude from what he said. And another he said was that the chances of recession are not highly elevated. He has not said it is ruled out. So I see it as a possibility, because whenever an economy from 0 interest rate goes to 2% within a span of 1 year, I think the financial conditions tightness will ensure that the economic activity slows down substantially. Now we get to it, how the market reacted. Stocks rallied, dollar fell. That's because all these things were very well discounted, and all these were as expected. Now, the important thing about the market was that yield curve between 5 and 10-year yields going into negative territory, or rather it's inverting.
Right.
So which is probably seen as a sign of recession. And the more popularly looked at yield curve between the 2 and 10-year actually fell to 22 basis points, which is the lowest since 2020. So Fed meeting outcome is mostly as expected. Market's reaction somewhat surprising, but again, not totally a shock. But then what the economy holds in view of this approach of Fed is what's very important, which we will analyze in the coming days.
Right. So, guys, as we saw, the dot plot is basically a survey for what the Fed members think, and market had very well discounted the Fed's 25 basis rate hike. My next question to you is actually on Chinese yuan. Now, we have been seeing an increase in the usage of Chinese yuan, and recently Saudi Arabia commented or made a statement, I don't know, formally or informally, that they are considering the usage of Chinese yuan for their oil deals. So, what would be the implication of if they actually end up using Chinese yuan?
Okay, I think Chinese yuan story has been evolving over the last 1 or 2 years in a much clear manner. The Chinese authorities are actually making the Chinese currency widely used, and for trade as well as even for investors. They've opened their economy a lot, and a lot of money has flown into the Chinese economy in the last 1 year. You can probably see that the yuan was one of the currencies that did not weaken even when the dollar index went up from 89 to 99. So that's one part of the story, that Chinese yuan has been strong because of the opening up of the economy and a lot of flows. Another thing that happened in the recent months is when there was a lot of risk aversion, so much so that people started buying gold and the Swiss franc. Chinese yuan also acted on par with those currencies, treated as a safe haven. Now, where does the trade thing comes? Now, when the war, after the war, obviously there has been a lot of sanctions on Russia. So starting point of yuan usage in trade is actually starting from Russia. And, because of the sanctions, Russians are unable to use their dollar reserves. At the same time, they have a huge trade with China. Russia supplies a lot of oil to China, and China in turn exports a lot of things to Russia. So the trade relation is quite high. So that means that they don't have to depend on dollar, which in this current situation, even Russia is not able to access. So it's a necessity by which Russians are probably going to think of using yuan as a medium of settlement for their trade with China. Then it comes, Saudi Arabia. Saudi Arabia, of course, there's a lot of change in the relations between US and Saudi Arabia in the post-Trump era. And analysts are seeing the report about Saudis using yuan for their oil settlement at the moment as a threat, not a real thing. But if it does actually happen, it won't surprise us, because again, the trade relations between Saudi Arabia and China exports its manufactured goods to almost all the countries. So there is a good amount of trade with all the major nations. And Saudi obviously is exporting its own oil to China as well. This can become, a new norm or the new way of settlements in the coming years. It's not going to happen immediately, but definitely it's so. Wherever the trade is strong between two countries, mutual trade or the bilateral trade, those currencies can actually emerge as settlement currencies, so that dollar's importance will be somewhat reduced. In fact, the extreme policies of USA on the monetary side as well as on the fiscal side, where they have now hit 30 trillion of debt, is something which is unnerving for the global investors and those surplus countries. How safe and how beneficial they would like to putting more money into USA is something that is questionable. So I see Saudi move and Russian move as part of a larger diversification process that may happen in the coming years to reduce the importance of dollar.
Right. So this is a larger diversification move, as JK said, to reduce the importance of dollar. Um, as we are on this topic of currencies, a lot of our viewers who watch this videos have interest in rupee. Now, JK, we had some big fundamental news: Fed FOMC rate hike. What are your expectations with the Indian rupee now?
Well, Indian rupee, of course, if you look at some of the fundamentals which are in play, like the trade deficit, foreign fund flows, oil price, all these things are against the INR, remaining strong. So we have not seen as much weakness in the INR in the face of these challenges as we would have otherwise thought. That's because of two reasons. One is RBI is armed with huge amount of reserves, over 630 billion. And their approach in the last few years, as we have seen, has been to keep the macro fundamentals stable. And rupee is one of the key macro fundamental factor. And that's what they have been seen. Whenever there is strong reason for rupee to weaken, what they have done is to adjust the rupee's range in a higher level, rather than allowing it to move substantially in one way, so that the disruption is avoided. And the same thing was seen this time also when the oil went to 130 plus, and everyone knows, looking at India's current account hitting more than 3.5% for the coming fiscal. That was when RBI got into the act, and they filled the gap between the demand and supply, and that actually ensured that rupee did not weaken substantially. In fact, it held almost near just above the previous all-time high of 76.92. But since then, we have seen it strengthen 2% from those levels. But what is the other factor that has helped rupee also in not weakening is the seasonal factor. It's the month of March, which is the financial year end for us. It's also the quarter end. And seasonally, every year, we have seen bunched up inflows from corporates, exporter hedging for year-end purposes. All these things create a excess of supply over demand, and that is what we are seeing pushing the dollar rupee rate down. Therefore, apart from this, when the rupee was weakening and huge amount uncertainty was prevailing due to war and oil prices, exporters had taken a backseat and they had not sold much of that. But after seeing the peace overtures, giving some positive signals, oil dropping below 100, the exporters have got into the act, and they have been steady sellers in the last few sessions. And apart what started as a support for the rupee from the RBI side, now it's actually being supported due to exporters selling in the market. So the outlook is that this is a factor which will remain till this month end. But even if oil stays above 90, it's well above our comfort level, our comfort zone. And as it is, our trade deficits are well over 20 billion per month for the last 5 years. If we have to balance it or see that it doesn't worsen, rupee should not be too strong. So my sense is that this current strength in the rupee is more seasonal and perhaps temporary. Post end of financial year 21-22, you will see some more weakness in the rupee in line with the fundamentals.
Right. So if I were to sum up what you said, sometimes when the fundamentals are not in India's favor, RBI thinks of shifting the range gradually, so to curb the volatility which happens. And the appreciation we are seeing now is mainly due to the seasonal factors of flows.
Yes.
Uh,
Yes.
well, JK,
And
that was quite
let me add
insightful.
this.
Yeah.
Let me add this, that even if suppose the rupee starts to strengthen too much from these levels because of supply being, and it's lopsided market positioning, I expect them to come back and buy dollars and once again see that rupee does not misalign itself with the fundamentals or the real effective exchange rate. So you can see RBI acting on both sides to ensure that the rupee is more or less in a stable range and moving the range along with the fundamental movement. And that is probably, I think we were in the 73.5, 76 range for the last several months. Now I expect them to move it to 75 and 77.5 range in the coming months.
Right. New range.
Yeah.
For the new financial year, probably.
Yes.
So of course, that was very insightful, JK. A lot of great insights, a lot of new topics which we covered this week, especially with the yuan and the shift in the rupee range. I want to thank you, JK, for coming in today and helping us go through the week.
Yep. Thank you.
And for all of you who are watching us, we do have another video which is being uploaded, which is on the trends and themes in the financial markets, which is actually hosted by my colleague Shikhar Garg, along with our technical research head Matthew John. Another great, insightful session. Do check that out. Check the video out if you have not seen it till now. So till then, guys, see you. Goodbye. Have a happy Holi. And I'll catch you guys next week.
Happy Holi and happy weekend to you all.
All right.
Thank you.